Good morning, stock hunters, and welcome back to the Daily Hunt for Multi-Baggers. It's Wednesday, October 29th, 2025, and we're digging into the social media buzz and market data from yesterday, October 28th.
That's right, Ethan. Today, we saw a pretty significant amount of discussion across a wide range of stocks. It was a very mixed bag, I'd say.
Absolutely. Some big tech names had a lot of chatter, alongside a few lesser-known companies really sparking interest. The overall market sentiment feels a bit like a tug of war, with some clear growth potential showing up, but also a lot of caution, around highly speculative plays.
Exactly. We'll be separating the signal from the noise, looking at where the market sentiment is strong and where the underlying financials, well, they just don't quite stack up.
All right, let's jump right into it. First up, we have UnitedHealth Group, that's UNH. Now, we've had a few different ratings for UNH recently, but today the buzz is overwhelmingly positive. We're seeing strong Q3 earnings, revenue beats, and they even raised their full-year guidance for 2025. Plus, people are really excited about Berkshire Hathaway reportedly holding a lot of UNH shares. It's definitely driving that buy-the-dip sentiment.
I hear you, Ethan, but let's keep a tight grip on the data, shall we? While the overall net profit margin is a healthy 4%, one user did highlight a sequential drop in the United Healthcare segment's operating margin from 3.1 to 2.1. We also have to consider that when users call it dirty cheap with a PE of over 19, that's still a valuation that implies growth. However, the 12.2% revenue growth and the strong momentum towards the 52-week high are compelling.
Well, the market clearly loves it, especially with that 2.4% dividend yield making it feel like a savings account for some. For UNH, we're looking at a buy.
Next, let's talk about Joby Aviation, JOB. This one is generating some serious skepticism.
Yeah, but hold on, Brooke. They just announced a partnership with Nvidia to power their next-gen autonomous flight. That's a huge name, And some analysts are even comparing them to early Tesla. There's a lot of excitement around eVTOLs generally.
Excitement, yes, but users are calling it a Nvidia boost that trivializes the actual impact. And frankly, the KPIs are a major concern. We're looking at negative revenue growth, no profitability with a 0% net profit margin and negative EPS, and an extremely negative operating margin. Plus, a beta of 2.5 indicates high volatility, and that's not the kind of volatility you want when the company is losing money hand over foot with a high debt-to-equity ratio of over 4.4. This isn't just skepticism, it's a financial red flag.
Okay, point taken. The fundamentals aren't there yet. For JOB, it's a stay away. Let's dive into Nvidia, NVDA, always a hot topic. We've seen a lot of mixed signals today. There's the Palantir partnership, users reporting successful options plays, and generally that Jensen stonk goes up attitude. The revenue growth is strong, and net profit margins are excellent.
Ethan, I'm going to have to pump the brakes a bit here. While the sentiment from that one successful options trade is bullish, the broader data points to extreme valuation. A PE of 57 and a PB of almost 49, with the current price just shy of its 52-week high, suggests that a lot of future growth is already baked into the price. Many users are actually quite cynical, describing the constant news as a circle jerk. High debt to equity doesn't help.
It's true, the valuation is certainly stretched. The market just seems to love the AI story, but the numbers do tell a tale. For NVDA, we're going to classify it as a stay away for new positions at this elevated price.
Moving on to Ondas Holdings, ONDS, the post was highly bullish, talking about building a drone empire and big government contracts.
And they're saying it could hit $10 before 2026, Brooke. Plus, news reports show analysts viewing them as entering a new growth phase. That kind of strategic expansion and potential government business, it's a huge catalyst.
Potential, yes, but the comments are full of caution. Users are pointing out it's up over 800% in 6 months, asking if it's already priced in and highly inflated. And when you look at the KPIs, it's unprofitable with a negative net profit margin and EPS, plus a very high debt-to-equity ratio and a PB over 15. The revenue growth is only 5.5%. It simply doesn't justify the current valuation or the market cap of over $2.6 billion on just $6 million in revenue.
Well, the numbers are indeed worrying, despite the ambition. For ONDS, it's a stay away. How about UPATH, PATH? We've had a mixed bag here over the past few weeks, but today we saw a user holding bullish calls, which is a good sign. And there's chatter about it being an AI stock worth buying.
A single user holding calls, Ethan, and another post where PATH is just mentioned as a past investment for someone looking at a different stock. Let's look at the numbers. An extremely high PE of over 538, a negative operating margin, and negative ROA just scream unprofitability. The debt-to-equity ratio is also high at 4.76. While there's some revenue growth, the company is still clearly struggling to turn that into profit. News also mentioned the stock sliding recently.
Okay, the bullish sentiment seems thin on this one. For PATH, we're going with stay away.
Let's talk about Roblox, RBLX. The main post had a very strong bearish take, calling it overvalued and bringing up serious ethical concerns.
True, but the highly upvoted comments were cynically bullish. People are saying the ethical issues are free publicity and that kids love this game and love spending their parents' money on it. The game is a money printer. There's a strong belief it will just keep going up, despite everything.
Money printer could not be further from the truth, Ethan. The KPIs show a significantly negative net profit margin, negative EPS, ROE, ROA, and operating margin. This company is deeply unprofitable. And let's not gloss over that absolutely insane price-to-book ratio of 258 and a debt-to-equity of almost 529. This is an extreme overvaluation that is not supported by any fundamentals. It's a classic example of market irrationality.
The market might be detached from reality, but that's still a stay away for RBLX. Now, for something that definitely is looking up, Nokia, NOK. This has been a huge story today.
It certainly has, with that massive Nvidia investment.
Right. We've seen posts about 1,300% gains, Nokia to the sky with Nvidia, and users saying its finally 5G tech is being recognized. The current price is near its 52-week high, and the revenue growth is positive. This Nvidia investment is a game changer that could boost future KPIs.
I agree that the Nvidia investment is a significant catalyst, and the market has responded strongly. But we did have one KPI decision today that flagged it as stay away due to a high PE of 40.89 compared to its relatively low EPS and net profit margin. While the news is excellent, the stock has already had a significant run-up. We need to be cautious about chasing returns after such a sharp climb.
I hear the caution, Brooke, but the sheer momentum and the strategic importance of that Nvidia deal, it suggests continued upside. For NOK, we're calling it a buy.
Okay, let's discuss Open Door Technologies, OPEN. The KPIs here are consistently alarming.
Well, some of the chatter points to it being a cheaper name and a technical setup for a bullish push or a squeeze if volume increases. Traders are watching for that potential.
Speculative short-term plays aside, Ethan, the company is fundamentally broken. It has negative net profit margins, negative EPS, negative operating margin, and an absolutely sky-high debt-to-equity ratio of over 346. The PB is also high at over 9. While the current price is off its 52-week low, the underlying business is unprofitable and carries immense financial risk.
Yeah, those are pretty tough numbers to ignore. For Open, it's a clear stay away. Let's turn to SoFi Technologies, SOFI. This one is looking incredibly strong today. We're seeing wee rocket posts, users reporting significant gains, and comments calling it the bank of the new generation.
Absolutely. The Q3 earnings and revenue beats, record member additions, and the raised full-year profit outlook are powerful. The 43.9% revenue growth and positive EPS are strong indicators. While the PE of almost 60 is high and the debt-to-equity ratio of nearly 60 is is something to watch. The company's clear trajectory towards sustained profitability and its successful expansion beyond lending are extremely compelling. The news is overwhelmingly positive, confirming a strong move towards financial health.
I think that expansion and strong financial performance completely outweigh the historical caution. For SoFi, it's a definite buy.
Next, Palantir Technologies, PLTR. We've got a real split here, Ethan.
Indeed. One post, 5 years ago you said buy PLTR, is full of users celebrating massive past gains and regretting selling early. There's real affection for this stock, and the Nvidia partnership sounds promising. Jim Cramer and Cathie Wood are bullish too. We're talking about almost 50% revenue growth here.
That past performance, while impressive, doesn't erase today's valuation reality. We're looking at an extremely high PE of 632 and a PB of almost 76. The sentiment on the Nvidia partnership post, despite the news, was actually bearish, with users dismissing it as the circle jerk must go on and questioning the practical utility of their AI. The current price is right near its 52-week high, which for that kind of PE just shouts overvaluation.
The market might be running on hype, but it's hard to ignore those extreme multiples. For PLTR, despite the user optimism, it's a stay away. Okay, let's look at Novo Nordisk, NVO. This has been a rough one today.
It has. The post titles like Buy NVO for Pain and NVO Not Very Optimistic pretty much sum it up. Users are complaining about daily losses and an endless dip. The current price is significantly below its 52-week high and dangerously close to its 52-week low.
To be fair, some users are suggesting patience and mentioning congressmen buying NVO, but it's really overshadowed by the negative sentiment.
And the news doesn't help. We saw reports of their stock falling amid a market uptick, and a competitor's GLP-1 RA drug actually bests semaglutide's glycemic control in trials. That's a direct threat to a key revenue stream. While they do have positive revenue and net profit margins, the market is clearly reacting to these competitive pressures and the overall downward trend.
Yeah, the sentiment is too negative, and those competitive threats are real. For NVO, it's a stay away.
Next, TeraWulf, WLF. Strong positive buzz, but let's dig in.
People are super excited about Wolf, Brooke. It's seen an 80% up day, and the talk is all about its transition to AI infrastructure. Even a $9.5 billion AI lease with FluidStack. There's a strong belief that the market hasn't fully priced in its Google connection and AI potential. Oppenheimer even initiated coverage with an outperformance rating. That's a lot of optimism, Ethan, but the fundamentals are deeply concerning. We have negative net profit margin and EPS indicating significant losses. The debt-to-equity ratio is astronomical at over 287, and the price-to-book ratio is extremely high at almost 38. This company is highly leveraged and trading at a substantial premium despite not being profitable. It's a high beta stock, meaning those gains can vanish quickly. It's definitely a wild ride, but the risk is too high given those financials. For Wolf, it's a stay away. All right, let's look at International Paper, IP.
So just to clarify for our listeners, the social media post for IP was actually discussing STIP strategy in the crypto space, which is a completely different company. We're focusing on International Paper, ticker IP, based on its KPIs and news. Now, for the real International Paper, while analysts like Stifel have upgraded it to buy and RBC maintained outperform, the KPIs paint a cautious picture. We're looking at a negative net profit margin, negative EPS, and negative return on equity, which means the company isn't generating profits.
That dividend yield of 3.84% is appealing, though, and they are making strategic moves like selling off some operations.
True, but profitability is key for dividend sustainability and long-term growth. Despite the analyst optimism, the current underlying financials are not supportive. For International Paper, it's a stay away.
Finally, let's talk about Applied Digital Corporation, APLD. This one has had some ups and downs, but today there's a huge wave of bullish sentiment.
Oh, Ethan, the social media posts are glowing, with users claiming APLD to the moon and citing 11 billion and 5 billion leases.
Exactly. They've secured massive long-term contracts, their AI data centers are ready for service, and users anticipate a massive inflow of money in upcoming earnings. Jim Cramer is even calling it hot as a pistol with a $56 price target. The revenue growth is strong, and the market cap is substantial despite current losses, showing serious investor confidence in its future.
I acknowledge the powerful catalysts in market enthusiasm, but we can't ignore the current financials. APLD has a very high beta of 6.59. It's currently unprofitable with negative net profit margin in EPS and has a high debt-to-equity ratio of over 184. Plus, we've seen reports of insider selling. The market is clearly banking heavily on future performance, and while those contracts are impressive, it's a high-risk, high-reward situation until the profits start flowing.
It's definitely a speculative play, but the growth potential with those contracts is undeniable. For APLD, we're marking it as a buy for those with a high risk tolerance and a long-term view on the AI infrastructure play.
And last but certainly not least, United Parcel Service, UPS.
The market actually rallied quite a bit on their job cuts and earnings speed, with some calling it plus 8% on the news. Analysts are saying the dividend is safe, at least for now.
That short-term rally doesn't change the underlying reality, Ethan. We're seeing negative revenue growth, a very high debt-to-equity of over 184, and the current price is significantly below its 52-week high, indicating a long-term downtrend. Users were screaming LFG to zero and raising concerns about declining revenue and increasing costs. That's a fundamental deterioration.
Yeah, the market might have liked the cost cutting, but the overall health is questionable. For UPS, it's a stay away. All right, let's wrap up our hunt for today. Here's our compiled list for deeper analysis. Investigate as buy. UnitedHealth Group Incorporated, common stock of DE, UNH. Nokia Corporation, sponsored American Depository Shares, NOK. SoFi Technologies, SOFI. Applied Digital Corporation, APLD. Investigate as cautious buy, none. Investigate as speculative gamble, TeraWulf Inc., WLF. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
That's all for today's Daily Hunt for multi-baggers. Thanks for tuning in. We'll catch you tomorrow morning with more insights.
Happy hunting!